You're listening to the Breakaway Wealth Podcast, the show that helps you build wealth faster, think outside the box, and break out of the herd. Here's your host, Jim Oliver.
Welcome back, Breakaway Wealth. I'm your host, Jim Oliver, and today we're going to talk about something everybody wants to talk about, and it's policy design, right? And I think people always want to talk about the policy. And I could take a crummy policy and really know how to use it, and somebody could take a perfectly designed policy, not know how to use it, and I will have better results. So it's really the coaching part of it and knowing how to implement, utilize, and grow infinite banking in your life, not just having the perfect policy and you think you're getting the highest dividends and you're getting the whatever. I mean, it's like this fascination with the policy comes because you're buying your infinite banking system and policies, what you need for your system, from life insurance agents and not from infinite banking practitioners, coaches, people with experience on how to use it to take over the banking function in your life. So what do you end up with? Well, you end up with a 90-10 policy or 80-20 or whatever the latest marketing crap is out there. And I'm going to talk about today why 90-10 policies quietly fail. And why more base wins in the long term. And really the thesis here is that it's like a car. Okay, my car has a turbocharger and then it has an engine with a bunch of horsepower, right? And the PUA is like the turbocharger and the base is like the horsepower. High PUA, they look really sexy, and that, I don't know if a turbocharger makes noise, but it's like having that Ferrari sound to it, right? It's sexy. And when you get off the line, the turbocharger, sometimes you can hear it. Maybe you can hear like in my car anyway, but it only helps you get off the line. What helps you get to top speed is the horsepower, and too little bit of base can hurt long-term performance and really reduce flexibility and reduce volume of funds available for your system. If you have too low of base, again, it can increase fragility and volatility, and really it's not a sound IBC design in the long run. In the short term, it looks great. So most advisors sell policies for illustration appeal, not for lifetime performance. They need, because they don't really know about infinite banking and they don't know how to use it, then they need a really pretty illustration. Same way with people that sell UL. If they're selling the illustration, I mean, these people have no idea that these things don't work, right? Show me one that's outperformed your illustration one time. Send it to me, Jim Oliver at createtailwind.com, because you can't. Show me somebody over 65 years old where their policy looks like it's great. You can't. Okay. So anyway, they want to show the client huge early cash value, low base, maximum PUA, and call it efficient. But real efficiency is not year one. Real efficiency is control, longevity, dividend strength, death benefit growth, both guaranteed and and dividend, policy resilience, and the volume of interest over decades, not the interest rate, but the volume of interest. And that's where many 90-10 designs break down. They just cannot withstand the stress of the long haul. And a policy is not just an accumulation tool, it's a financing system. So when you look at it as an accumulation tool and you look at it on what's your rate of return, all this stuff, that's not how to look at it. It's a financing system because we're solving one problem. We finance every single thing that we buy. We either pay interest to someone else or we give up interest we could have earned somewhere else. There are no exceptions, to quote Nelson Nash. And for a financing system, we need a few things. The first thing you need in a financing system is durability. Second is predictability. Third is room to expand, strong guarantees, strong base structure, right? You would never build a house with a small base and a lot of upside like this, right? I mean, I'm not an architect or an engineer, but I would think that wouldn't be very sound. And then long-term compounding power, okay? A design that wins only the first few years is not necessarily the best banking system, okay? And there are really two camps. You have these guys that are great at marketing and they want high-PUA and they sell you on, look, the first year cash value, 80% or something like that, right? And so they want high-PUA on there for a long time, maybe 10 years, maybe longer, and a low base. And the way why people like it is there's more early cash value. It's an easier sale, prettier illustrations year 1 through 5 or ish, and lower initial drag. Okay, cash drag. It's lower in the beginning, but the problem here is Nelson tells us to think long term. Now, I learned this from the source. I learned infinite banking from Nelson Nash, and I would go to Nelson's think tank every year to see Nelson, to listen to Nelson, right? I don't go so much anymore because I don't need to listen to other people talk about infinite banking. I really want to hear Nelson talk about it. I'd rather watch his 10-hour seminar on video, right? Than talk about how somebody else is marketing it. And the problem with 1090 is you have a weaker long-term structure, less permanent base death benefit per premium dollar, more dependence on riders and ongoing funding patterns. Like what we normally do, like Nelson did in a lot of his examples, is we put the PUA on there until the policy base is efficient, meaning I put in $1 and I have more than $1 to use, or at least $1, right? So that's typically the way that we would do it. So 90-10, it's less resilient if the client changes funding later, right? I mean, and there's mech risk, there's lots of other stuff that goes along with that. But the mech risk is real when you're at 90-10 and you're really thin and you have turn costs, okay? I don't know what age these people are that are buying these things, but when you get in your 60s, what do you think term insurance costs are? They're high. Is that really what you want? What if you have to keep that rider on there because of a mech issue, right? I mean, it's just going to get more and more expensive and erode that pretty illustration that you're looking at. But then the higher base side, and when I say the higher base side, this is the higher base design camp, Nelson Nash, Create Tailwind, our friends out there that know how to do this and have been doing it 20 plus years, and they've seen ups and downs, and people use their infinite banking systems to make millions and millions of dollars. And then they've seen other people where their policies crash and burn because of poor design. I mean, there was an insurance company that lowered their dividends, and people don't realize that if they lowered their dividends, then that can mech the policy. Right. And people tell me, I never sold any of these policies with this company, but they told me that they didn't get notice. Now, this is only like 2 or 3 people. So did they get notice? Maybe they did. Maybe they didn't open their mail, whatever. Right. But, 40% PUA, 60% base, 50% base, 50% PUA, 60% PUA, 40% base, somewhere in there, depending on the case design, the carrier, etc. And it wins later. It's the horsepower, right? Remember our car. We're going to get into that in a second. But why it wins later is it has a stronger contractual foundation, stronger long-term policy mechanics, better permanence. Okay, now remember, we're buying this for the rest of our lives. That's why they call it whole life, right? Often a better long-run efficiency after the crossover years, somewhere between 5 and 8. And it's more aligned with true banking philosophy, right? Which is, I need volume of dollars, somebody else's dollars, to go lend to someone else, right? Think about how a bank works, is you got a depositor, the bank, and the borrower. And the bank needs the depositor's money to go loan to the borrower. Can those people be the same people? They can. So then they're making money with your money from you. And who would do that, right? I mean, if you knew what, like Nelson say, if you know what's happening, you'll know what to do. So let's talk about this turbocharger horsepower section. And I just want to qualify for any real gearheads out there that I am not a gearhead. Okay. I'm not really that much of a car guy. I like nice cars, but I'm going to butcher this maybe in some ways because it's just the way that it's just an analogy. Okay. So turbocharger versus horsepower, and the PUA is the turbocharger and it gives quick acceleration. Okay. Think of it like an engine. The base horsepower is the engine. It's the thing that gets you to the quarter-mile finish line at top speed. You don't build a great truck by putting a giant turbocharger in there and a weak motor, right? Same with whole life. If the base is too thin, the policy may look great early, but the underlying machine is weaker than people think. So why did this become popular? Well, consumers want quick access. Now, so remember that, like if you go into the bank, you have to make an investment in the bank to be a customer. If you were the owner of the bank, would you have to make an investment? Yes. And would you automatically day one be making money? Not as an owner of a business, right? But will you eventually make money? Yes. So would you rather be the employee, the consumer, that mentality, or do you want to be the owner? Employee, consumer, my paycheck comes on this date. I put my money in. I start to get interest today, immediately. That's the consumer or customer or employee mentality. The owner says, I'm going to make an investment in this business today, and down the road, I'm going to make a profit, and that profit's going to grow and grow and grow and grow and grow. That's thinking long term. And if you're confused by that, or you want to see a great example, is look at IBC Sister versus CD Sister on page 45 of Nelson's book, Becoming Your Own Banker. Because as soon as they start banking, the IBC Sister blows past the CD Sister, who's pretty, is ahead. And the IBC Sister never looks back. And on a very small amount, ends up with another $700,000 of cash and death benefit and all these other things that the CD Sister can't match by being the owner, by being behind in the beginning. So why did 90/10 become popular? Consumers want quick access because they're consumers. Advisors, life insurance agents that pretend to be infinite banking practitioners, they want easy closes. I want to make that illustration the easiest thing that you'll buy. And the illustration rewards short-term thinking, right? And because people confuse early liquidity with true efficiency, they get confused. And many advisors were never taught how base creates long-term compounding power. All they're taught about is how to sell life insurance. So they really just see infinite banking is life insurance, life insurance. Let me tell you about the insurance company that I represent. Let me tell you about the dividends. Let me tell you about the structure. Let me tell you about your first year cash value, second year cash value, all that. That's what they want to talk about. But it's partly because it's just a sales culture problem. It's easier. It's simple. It's easier to sell fast cash value than long-term strength. Is it better? Well, no, I don't think it's better, because what Nelson really cared about was Nelson was not chasing the prettiest year one illustration. He talked about all the time that the best policy would be a base policy, but people don't like that they don't have much cash in that first year, if any, some companies, and people don't want that. And so he said, that mixing in the PUA to be like a turbocharger, I'm not sure he ever used those words, was the way to make the policy good in the beginning and good long term. He cared about control, uninterrupted compounding, ownership of the policy, and acting and behaving like an owner, volume of interest, capitalization, and long-term use of the system. That matters, because if your design maximizes early cash value but weakens long-term or long-run capitalization, you may be missing the whole point. So let's just talk a little bit about this volume of interest. And this is one of the most important sections that we're going to talk about is wealthy people do not just chase rate of return. They care about the amount of capital earning over time, right? I mean, think about it. If you had $100,000, would you rather get 50% on $100,000 or 10% on $10 million? I mean, that's a dumb question. That's volume, though. And a stronger base policy often creates more powerful long-term capital pools of money. And what this means is you have more dollars compounding, more stable collateral capacity, more financing power, more death benefit leverage, more room for future banking activity, which we want. We want to be able to use this thing and make it super efficient. So even if a high PUA design looks better in year 2, the stronger base design can create more total economic value later because the engine is bigger. So that's, again, the turbocharger. Do you care how fast you are for the first, 200 yards or how fast you are at the end of the quarter mile? Because the horsepower is what's going to have that second, the latter, how fast are you going at the quarter mile, which is key to having the best quarter mile time, right? But it's not going to be the most efficient in the first, say, 200 yards. That's why we have the turbocharger. So there's a crossover point. This is the money section right here. In participating whole life designs, there's a period where heavy PUA wins early, then base later, base heavy or more balanced designs start catching up and outperforming. And that typical window is around year 5 to 8. Sometimes later, depending on the carrier, dividend scale, age, underwriting class, if you had term in there, premium size, policy objective. But the reason that crossover happens is because the base premium is buying stronger permanent insurance foundations that continue to produce value over time. And the PUA gives you excellent early cash value, but doesn't always create the same long-term structural advantage when the base is too thin, i.e. 90-10. So let me give you a couple of examples, right? If policy A on this side is 90% PUA, 10% base, policy B on this side is 60% PUA, 40% base, and let's assume the total premium is like 100,000, right? We don't even have to think about like actual numbers. Just know year 1 to 3, policy A usually shows better early cash value. So maybe in the first year, you're going to put in 100,000 and you're going to have 80,000 with them. And with the stronger base or the larger base, you're going to have maybe 64,000, somewhere in that range. Okay. Depending on your age, underwriting class, etc. So why, if it's 90-10 and the PUA is dollar for dollar, why aren't we having 90%? Well, there's a couple of reasons. One, most of the people that do these 90-10s, they work with companies that have high PUA commission. And so there is cash drag on the PUA. It's not dollar for dollar exactly, right? There's a load in there. That's number one. Number two is they have to put a term policy on there to make it not MEC. When you put that term policy on there, there's a cost, cash drag in that first year, okay? And every year that term policy is on there. So, what they're going to say, again, look how efficient it is year 1 through 3. Then years 4 through 7, the gap starts to narrow. Balanced designs begin showing stronger underlying policy behavior, right? You start to see the base policy get up to speed. And it really starts even as early as year 2 for that. Years 7 to 10, now the stronger base design becomes more compelling economically, more permanent death benefits, stronger long-run capitalization, and better overall banking value. You could say it like this, is the first design wins the sprint, and the second design often wins the business. That makes sense. And I think when we're looking at business owners and wealthy families and highly paid to people and real estate investors that are making a lot of money, But the 5 mistakes that I see with these larger policies, because we're building a big bank, right? Say $1 million to $5 million of capitalization per year, right? One is they design it for illustration optics, right? To optimize the sale, not 30-year performance, but for the sale. And by underfunding, the second mistake is they underfund the base, like we just talked about, which weakens the chassis. And to make the first page look good, it weakens everything else. And number 3, they're ignoring future flexibility, because we want to be able to, once we drop that PUA off, is still fund. I mean, we're going to have more capital to put through the policy, not less, which means we'd want to keep that PUA on there longer and longer and longer. And those guys love it because they're getting commission every single year that you dump that PUA in. But clients' income and goals can change. Then base designs can become very fragile. And remember that MEC line. If you treat that MEC line as a target, avoiding MEC is a constraint, not a strategy itself. And the 5th mistake that they make is failing to model long-term use. A banking policy should be stress tested for loans, expansion, interruptions, policy longevity. All right, so let's just be direct here and talk about the risks and limitations of 90-10 designs. 90-10 is not automatically bad, but it has risks. It's over-optimized for early cash value. Weaker long-term structure, more dependence on rider continuation, less forgiving if premiums change, more vulnerable if a client cannot maintain ideal the funding schedule or pattern. Lower emphasis on permanent base buildup, okay? So, which is safe and guaranteed and easy, may conflict with the spirit of capitalization first banking, which is Nelson's thing, is don't be afraid to capitalize. And what's the translation of all of that? Is it can work on paper, and so can UL work on paper. It doesn't work in actuality. UL has never worked in actuality, and I can go through that, and we're going to do an episode coming up on that. But it may not be the strongest banking system forever. So why can more base be better after year 4, let's say? And after those drag years, and it's really the first year. The second year is in the 90s, some percentile, plus you got this death benefit. So if you were going to buy term insurance anyway, let's just call those year second or 2, 3 or so even, close to even. Really the first year is the cash drag. Guarantees, the base starts to matter more and more after year 4 because the guarantees matter more. Permanent death benefit matters more. Dividend-bearing structure matters more. Capitalization matters more, having to be able to put more money in. I always ask people in year 10, if you wrote me a check for $100,000 and I'd let you have an interest-only loan for $150,000 from that $100,000 deposit, how many times a day would you want to do that? All day long. Okay, so we got to get there. By the way, year 11 is going to be more efficient than year 10. Year 12 is going to be more efficient than year 11, and so on and so on and so on. But capitalization matters more. The system becomes more durable. And in the beginning, PUA reduces friction. You can see it like that. But later, base builds strength. At some point, strength beats speed, right? And so, it's kind of like working out. You can do push-ups or you can do bench press. Now, the advantage of bench press is there's way more flexibility in the weight. All you can do when you're doing push-ups is that you could do it slower, you could do like some variations, but you only have your body weight to use. Now, think about when you're doing bench press, you could have very little weight. Oh, but the bar is 45 pounds, an Olympic bar, and you could have 500 pounds on there. Lots of flexibility there. So which one is going to make you stronger? The bench press. There's no question about that. All right. Some of the nuances, right? That how to design the policy. So hopefully we've thrown out that designing it with more PUA is really not the way to do it long term. But how we design it, whether it's 60-40, 50-50, or 40-60, or somewhere in that range, or 70-30, or whatever it is, 65-35 as clients' age, cash flow consistency, the purpose. Is there a certain purpose? Like, are we going to just use this policy for cars? Are you a business owner? Are you W-2? Are we using this for money pool for investments? Your scale of premium. How big is the premium going to be? Your time horizon, your need for flexibility, your estate objective, your financing intent. What is the intent of this policy? But the mistake is thinking the maximum PUA is automatically the best. It's not. So who should consider more base? Serious IBC practitioners that want to build long-term wealth. Business owners wanting long-term financing systems. Families building multi-generational policies. Clients funding 7 figures yearly or over time. People who want or value durability over optics, right? This is not for the person that it wants the flashiest color car that they can get, because you're probably going to buy a UL or something. And again, there's nothing wrong with flashy, but like, you can be flashy, just make sure that the car is sound. They want a policy that can take pressure. And who might still want heavier PUA? Someone prioritizing early access, someone with a shorter time horizon, someone using a niche design for a very specific purpose. I can't think of one. Someone who fully understands the trade-offs. But you know what? They have to understand what they're giving up. And most people, if they understand what they're giving up, they wouldn't give it up. They would make it the way Nelson made it, honestly. So the best illustration, here's just some takeaways. The best illustration is not always the best policy. Early cash value is not the same as long-term efficiency. PUA gives you speed, base gives you strength. Thin base designs often look rich early, act poor later. Banking is not about winning year one. It's about controlling capital for life. A policy should be built to perform under pressure, not just a spreadsheet. And maximum funding is not the same as maximum wisdom. You do not build a dynasty on short-term optics. All right, so if you're designing policies for real banking, not just sales appeal, you have to think beyond the first few years. The goal is not to minimize the drag. And the goal is to build a policy with staying power, capitalization, flexibility, control, long-term compounding force. And that's why base often wins where it matters most. Not in the sales meeting, in real life, in year 10, in year 20, in year 30. If you want, I'll show you the difference between a policy built to impress and a policy built to perform. Because when you understand the difference, you'll stop buying illustrations and start building your own banking system. That's it. I mean, that's why we have to think like Nelson did. And remember, this episode is the truth about PUA, base, MEC, building a real policy for real life, not sales optics. And, I just want you guys to understand that Nelson tore it apart. Not just illustrations in 2026, not illustrations in 1980, but everything in between, in every condition. So we want this stuff to be able to survive and have longevity and be efficient. And we want to build the system. So we got to build on a solid base. All right. So again, if you want to more details of this, we're going to talk about UL in the next few weeks. Just send me an email or in the community, ask me a question or tell me I'd like to hear this on the podcast and I'll do it. Okay. I want to give you guys what you need to either grow your system, get you started with infinite banking, wherever you are on this journey, I want to help you. All right. Thank you very much for being here. And we're going to wrap this up like we always do with the incredible words of Earl Nightingale and The Strangest Secret. Take it away, Earl.
Here's the key to success and the key to failure. We become what we think about. Now let me say that again. We become what we think about.
Thanks for listening to the Breakaway Wealth Podcast. Be sure to subscribe to this show wherever you're listening so you never miss an episode. If you want to start increasing your wealth building ability right now, go to community.createtailwind.com to join our free online community and get access to free, in-depth training designed to help you build real, lasting wealth. See you next week.